The US government just announced over $35 billion in new tariffs. And whether you realize it or not, your wallet and your investments might feel it very soon. Now I get it. Tariffs sound like one of those distant political things that only CEOs and trade officials worry about. But the truth is, this could be one of the most expensive hidden taxes Americans have faced in years. You won't see it on your tax return. You'll see it in the price of your car, your phone, your groceries, even your streaming bill. Here's the thing. Every time the US raises tariffs, the cost doesn't just stay overseas. It finds its way back home into the pockets of ordinary people like you and me. And what makes this story even more important is that it's happening at a time when inflation was finally cooling down, until now. In today's video, we're going to break it all down, simply and clearly. What these new tariffs actually mean for you, why economists are calling it the hidden tax on every American, how it could shake up stocks, inflation, and the US dollar, and most importantly, how you can protect your portfolio before the market reacts. If you care about your money, your future, or just understanding how these policies shape your financial life, you're in the right place. Welcome back to Mindset for Wealth, the channel where we make sense of global finance and help you think like an investor, not a spectator. If you're new here, make sure to hit subscribe and turn on notifications so you never miss insights that could literally save you thousands. All right, let's break down what's really happening behind those $35 billion tariffs and why they might quietly cost you more than you think. What's happening? Understanding the $35 tariff move. So what exactly is going on here? Last week, the US government officially announced a new round of tariffs worth more than $35 billion, targeting imports from China, the European Union, and Mexico. We're talking about products like automotive parts, steel, semiconductors, solar panels, and electric vehicle components. Basically, the building blocks of modern manufacturing. The official story is simple. The US says these tariffs are meant to protect American jobs and industries, to make sure the country doesn't depend too heavily on foreign production. It sounds patriotic, and in theory, that makes sense. Who doesn't want more jobs at home? But here's where it gets complicated. When the government slaps tariffs on imports, foreign companies don't usually eat those costs. Instead, American importers, the companies bringing these goods into the US, are the ones paying the tax. And guess what? Those importers aren't taking the hit either. They simply raise their prices so they don't lose money, and the final bill lands right in your pocket. That's the invisible chain. The government charges, importers pass it on, consumers pay it. Let's make this real. Imagine you buy a new car. That car may have parts made in Mexico, steel from Japan, or chips from Taiwan. Every piece of that car just got a little more expensive, and so did your loan payment. Or when you buy an iPhone, same story. Apple doesn't absorb tariffs. It adjusts prices, trims discounts, or shifts costs through the supply chain. The result? You're paying more, without realizing why. Now, let's talk timing. These tariffs come at a delicate moment. Inflation has been cooling down, gas prices have stabilized, and the Federal Reserve was finally considering rate cuts in 2026. But a $35 billion tariff wave adds friction to that recovery. Higher import costs mean higher prices, and that can push inflation back up, forcing the Fed to delay or even reverse its plans. Wall Street knows this. That's why markets have been jittery, with investors trying to figure out whether these tariffs are short-term politics or a long-term strategy shift. And while politicians argue over who wins, the reality is that the average American consumer ends up footing the bill. It's what economists call a hidden tax. Because even though nobody's raising your income tax, the prices you pay every day are quietly creeping higher. So, when you hear that the US just hit global companies with $35 billion in tariffs, remember, that number doesn't stay on a spreadsheet in Washington. It travels into the price tag on your next purchase and eventually into how much your money is really worth. The hidden tax explained. Let's call this what it really is, a tax on every American, just one that no one voted for. Because here's the truth, tariffs don't just punish foreign companies. They punish consumers, quietly, slowly, and across everything you buy. Here's how that works. When the government adds a tariff on imported goods, it's like putting a toll on every shipment that crosses the border. The company importing those goods, say Ford, Apple, or Walmart, has only two options: absorb the cost and take a profit hit, or pass it along to the consumer. And 99% of the time, they choose option 2. So even though you didn't pay a new tax, you start paying a little bit more for everything: the car you drive, the phone in your pocket, and the groceries in your cart. Let's make this more concrete. A typical mid-size car today uses over 30,000 individual parts, many imported. Even a small 2% tariff increase on steel or electronics adds hundreds of dollars in production costs. By the time that car reaches you, it's $1,000 to $1,500 more expensive. Or think about smartphones. Apple might not raise the base iPhone price right away, but it could trim trade-in values, reduce discounts, or quietly push you toward more expensive storage options. Either way, you're paying more for the same thing. And it doesn't stop there. When businesses face higher costs, they also raise prices on unrelated products to protect margins. That's why even your Netflix subscription or Amazon delivery fee could increase, because tariffs disrupt entire supply chains, not just one product. This is why economists call tariffs a hidden inflation engine. They don't show up as a new tax on your paycheck. They show up as creeping price increases everywhere else. And what makes it worse is timing. Most Americans are already feeling the squeeze from 2 years of elevated inflation. Wages haven't fully caught up, savings rates are down, and credit card debt just hit new highs. So when tariffs quietly push prices higher again, it's not just inconvenient, it's painful. The irony? Tariffs are often sold as a way to help working Americans by protecting jobs and promoting domestic production. But in reality, they can hit lower and middle-income households the hardest, because those families spend a larger share of their income on essentials, like food, fuel, and household goods. And that's the part most politicians won't say out loud. Because calling it a tariff sounds strategic. Calling it a hidden tax on consumers? That sounds like accountability. So, the next time you hear that the US government is making foreign companies pay, remember, they might write the check, but you're the one cashing the consequences. The market impact, stocks, inflation, and the dollar. So now that we know how tariffs quietly raise prices, let's talk about what they mean for the markets. Because when Washington plays with trade policy, Wall Street always reacts. And right now, the reaction has been a mix of nervous optimism and quiet fear. Here's why. When tariffs go up, costs go up for companies that rely on imported materials. That means lower profit margins, at least in the short term. And when profits fall, stock prices often follow. But not every stock reacts the same way. Some sectors actually benefit, especially those that compete with imported goods. Let's break it down. The potential losers. Technology and electronics. Companies like Apple, Dell, and Tesla depend heavily on imported components. Even small tariff changes can squeeze profit margins or delay production. Automotive and manufacturing. Car makers that source parts from Mexico or Asia face higher costs per vehicle. Ford and GM already warned investors that trade costs could cut profits by up to $1 billion this year. Retail and consumer goods. From Walmart to Target, any business importing from Asia will likely pay more to stock shelves, meaning thinner margins and potentially higher prices for you. The potential winners. Domestic manufacturing. Companies that produce in the US could see a short-term bump in demand. Think US steelmakers or local equipment suppliers. They suddenly become more competitive. Energy and infrastructure. If tariffs shift capital back home, these sectors could benefit from reshoring projects and federal incentives. Defense contractors. Historically, trade tensions often lead to higher defense budgets and stronger spending in related industries. Inflation and the Fed's dilemma. Here's where it gets tricky. The Federal Reserve has spent over 2 years trying to bring inflation down. And just as prices start to stabilize, these new tariffs add fresh pressure to the system. It's like putting another log on a fire that was finally cooling down. If import costs rise, companies pass them on. Consumer prices tick up, and suddenly, inflation starts creeping again. That means the Fed might delay cutting interest rates, or even signal the need to hold them higher for longer. For investors, that's a double hit. Stocks could face valuation pressure as borrowing costs stay high. Bonds could drop as yields remain elevated. And housing, already squeezed by mortgage rates, might cool even more. The US dollar and gold factor tariffs also shake up the currency markets. When the US imposes trade barriers, global investors tend to buy dollars as a safe haven. So in the short term, the USD might strengthen. But if tariffs slow global trade or trigger retaliation from China or Europe, confidence in US growth could weaken, and the dollar could reverse course later. That's why we've seen gold prices inch higher again. Investors are hedging against uncertainty, not panic, but preparation. Market psychology, the hidden fear. Beyond charts and data, markets move on psychology. Investors don't just trade on what's happening. They trade on what they fear might happen. And right now, that fear is, are we walking back into another trade war? If history tells us anything, like in 2018, markets can stay volatile for months before finding direction. So expect more swings, more headlines, and a lot more confusion before clarity arrives. But here's the good news. Volatility also means opportunity for investors who stay informed, patient, and strategic. Because at the end of the day, tariffs might be political, but how you react to them, that's financial. And that's where smart investors separate emotion from strategy. Smart investor moves, how to protect your portfolio. Okay, so now that we know how tariffs can hit your wallet, your budget, and the broader markets, let's talk about the part that actually matters most. What should you do about it? Because the truth is, most people panic when they hear tariffs, inflation, or market volatility. They sell too soon, chase trends, or sit in cash waiting for certainty. But smart investors? They do the opposite. They prepare, not panic. Let's walk through 3 key moves that every investor should think about right now. Don't trade the headlines. Trade the fundamentals. Markets react emotionally to news, but headlines change every hour. Fundamentals don't. Tariffs might shake prices short term, but the long-term value of great companies doesn't vanish overnight. If you invest in businesses with strong balance sheets, consistent earnings, and pricing power, they can usually absorb short-term shocks. Think about companies that can pass on costs, control supply chains, or innovate fast. That's why when fear hits, it's often the best time to add to positions you already believe in, not abandon them. Diversify, but with purpose. You've heard diversify a million times, but here's what it really means right now. Don't just hold different stocks. Hold different asset classes that move differently when volatility spikes. For example, a small position in gold or commodities can hedge against inflation. Short-term bonds or T-bills can offer safety and yield, while the Fed stays cautious. Even international exposure, in markets less affected by US tariffs, can reduce your overall risk. Diversification is not about owning more stuff. It's about building a portfolio that can survive bad news without destroying your peace of mind. Focus on time, not timing. Every time the market drops, people try to outsmart it. But timing the market perfectly is almost impossible. And waiting for the perfect entry usually means missing the recovery. Tariffs, inflation, elections, they all come and go. But over decades, the market has rewarded discipline far more than prediction. So instead of asking, what happens next week, ask, what will I wish I had done 5 years from now? If your strategy is built around that mindset, you'll always win the long game. Remember, every period of uncertainty creates opportunity. When most people run for the exits, that's often when future wealth quietly changes hands. So don't fear the headlines. Understand them, prepare for them, and keep your mindset for wealth. So, what's the real takeaway here? The $35 billion in tariffs might sound like a government headline, but in reality, it's a hidden tax that touches every American. From your grocery bill to your 401k, these policies quietly shape what your money can buy, how your investments perform, and what your financial future looks like. But here's the good news. Once you understand how the system works, you're no longer controlled by it. You can plan around it. You can invest smarter. You can make money work for you, not against you. And that's exactly what we do here at Mindset for Wealth. We take complex global finance and make it simple, actionable, and empowering. If you found value in today's breakdown, do me a favor. Hit that subscribe button, turn on notifications, and join our growing community of investors who think critically and act confidently. Because when you master your mindset, you master your wealth.